So this presentation is about some research that I've been working on for a few months, really about trying to quantitatively decompose the drivers of home prices in BC over about the past 4 decades. Um, Often in the media, we hear a lot about it kind of focuses on one thing or another, whether it's foreign investment or toxic demand or whatever. So usually, economists listen to media commentary about the Vancouver housing market, especially. We hear supply doesn't matter and the market's totally decoupled from the local economy and all of these things. And generally, most of what you read about in the media about the housing market is pretty poor analysis, and a lot of it is just sort of focuses on one issue and ignores everything else. So that's really what this research is arising out of. Just how can we look back in history and figure out what's really driving home prices over the long term. This part's a little technical. I'll kind of skip over it. Some of the, if you people are econ majors, you might get to some of this stuff at some point. What we did is estimate a type of time series model called the vector auto regression with what are called sign restrictions. So in order to identify shocks in this model, we need to have some restrictions. One way to do that is through restricting, basically, when you introduce a certain shock to the model, kind of restricting it in a way that you get a pattern that looks like a supply shock or a demand shock or whatever. So we identify, say, a supply shock as increase in home prices. The supply of listings falls, home prices rise, employment falls because residential investment falls as well, so on and so on. So there's just a way to identify shocks in the model itself. It gets very technical. If anyone, I doubt, will have a question, but I can certainly answer questions about that part. So there are 4 shocks in the model. The first one here is a mortgage rate shock. So same kind of thing. Interest rates fall, perhaps because the Bank of Canada has cut rates, or we have some other reason that mortgage rates have fallen, some impact on the medium part of the yield curve. Doesn't really matter for this exercise. Interest rates fall, home sales rise, home prices rise. We get an increase in employment due to an increase in residential investment in the economy. Developers start building more because they see rising prices, and that eventually leads to an increase in supply. So we have these sort of restrictions on the sign. The sign in the model for interest rates would be negative, would be positive on the other variables. Same thing about price expectations. You might think of this as sort of a fear of missing out or a FOMO type shock. Prices rise. And then buyers want to get into the market before prices rise again. You get this sort of recursive kind of a feedback loop where prices are rising because we expect prices to rise. Interestingly, the shock that we identify in the model fits kind of empirical measures of price expectations pretty well. If you look in the chart on the right, our price expectation shock against the Bank of Canada's quarterly survey of price expectations for the BC housing market, our identified shock tends to fit that empirical data pretty well. And then on the supply and demand side, our measure of supply is new listings, new residential listings, and it sort of shocks to those listings. So if you look at a period like 2015 to 2016, when new listings were really low, the model would sort of expect listings to be higher, and because they're not, that difference is sort of interpreted as a supply shock. And then on our demand shock, it's really based on the local economy. So we're trying to capture a demand that is a demand shock that is driven by strong employment growth. So really linked to the local economy. So we estimate the model. We get these sort of what are called impulse response functions. When you apply these shocks to the model, what we're just kind of looking for with these impulse response functions is that our sign restrictions are kind of showing up. So everything's kind of normalized to rising prices. You can see a supply shock means a rise in real home price growth, which lasts for a while. There's the kind of a lagged effect, and there's sort of these the shock diffuses over time. So supply shock, you can see prices up, new listings down. The sales to new listings ratio is in there to really capture movements in home prices. It rises because listings have fallen and demand has stayed where same. Real mortgage rates were unrestricted. Employment growth falls, so on and so on. Demand shock looks like a rise in employment growth, rising new listings as potential sellers list their homes to take advantage of higher prices, so on. So we get the right identification through that process. This is kind of what it looks like, what these shocks look like as they kind of diffuse through the housing market. So there's different lags, different magnitudes for each of our identified shocks. Over the whole sample, so this was estimated over 1982 to 2020. The most important shocks were shocks to demand and to mortgage rates. No surprise. Expectation shocks were sort of the third strongest driver of home prices, and then supply the fourth largest, but still pretty significant. Interestingly, we identified 4 shocks in a model with 5 variables, which means there's sort of one shock left unidentified. So there is a residual in this model, or parts of home price sort of variance we don't capture, because a lot of this is about this is a BC based model, BC average prices, but 60% of that is really Vancouver. So anytime you talk about Vancouver, and anytime we estimate models about Vancouver, there's a residual, the mind immediately jumps to foreign capital or foreign investment or money laundering or things like that. We looked at the model residual and compared it against the data that we have for foreign investment, and they're just not correlated. So whatever's in that residual, whatever the unidentified shock in this model has nothing to do with foreign investment. It's actually, I think that foreign investment is being picked up in other parts of the model, probably especially the expectations variable. So just to, always have to sort of clear your throat talking about foreign investment whenever you talk about Vancouver. That's sort of where the media often jumps as well. So it's one of the hassles, one of the least fun parts about my job is having to sometimes really re-educate the media about what's going on and sort of shoot down some ideas that get into the popular kind of perception. So with this model, what else we can do is decompose all those shocks into drivers over time, and sort of allocates kind of weights each of those supply, demand, mortgage rate, and price expectation shocks back through time, and kind of look at over the whole course of the data that we have for home prices, what really has been driving the BC housing market at different times over the past close to 40 years. The really interesting ones, if you look at that kind of late 80s spike, or I guess the most interesting one that jumps out right away is home prices really crashed in the early 80s. A lot of that due to we had basically prices in Vancouver doubled in 1981, and then fell, I think, about 40% in 1982. A lot of that was because the BC economy was in its worst recession in its history, which shows up here as a pretty big demand shock. So you see that those orange bars mean that that demand was negatively impacting home price growth, and then price expectations falling as well as that sort of bubble popped throughout the early 80s. You see a big impact from, it shows up in green. That's due to mortgage rates, which had been as high as about 21% in the early 80s. A lot of you, if you're studying the housing market, it'd be pretty startling to see mortgage rates at 21%. But that was kind of the norm when we had very high inflation in the 80s. Right now, a 5-year fixed mortgage is about 1.8. So it's pretty startling to think that it could ever be in the double digits, let alone 20%. From there, we see a huge spike in home prices that happened in the late 80s after Expo 86, and after we had a huge immigration from Hong Kong post 1987. That shows up a lot as a big spike in price expectations, but also that was a time when we had a very undersupplied market. Listings were really low, and so supply was putting upper pressure on home prices as well. Um, Throughout the next couple decades, we had not things, were certainly interesting, but not as, we had a very low supply era throughout the mid to late 90s. All of you are probably way too young to remember we had a leaky condo crisis in the 90s. So developers were building apartments that had leaks, and that really hurt the housing market and really hurt residential construction through a lot of the 90s. So we had very low supply. So you can see that start to show up in the kind of early part of the 2000s, because we just weren't building enough in the late 90s. And then with the financial crisis, 2007, 2008, 2008, 2009 shows up here as a big shock to price expectations and mortgage rates, because at the time, even though the Bank of Canada was cutting rates, the mortgage market was sort of melting down. There was a huge risk premium attached to mortgage rates. So mortgage rates were rising at a time when Bank of Canada was cutting. We had a rebound in 2009, 2010. Then we had, what is that decline? 2012 is really about changes to CMHC policy. We have 2016 foreign buyers tax, which here shows up as a big hit to demand and price expectations. That 2015 to 2016 period in general, which we'll kind of isolate in a second, is pretty fascinating. I think actually I have a chart and a couple slides here that really isolates 2015 to 2020. So we'll skip ahead to that. But we look at over that whole period and really just isolate times when home prices were really accelerating and look at the major drivers. You can see that 88 to 89 period was a lot about home price expectations, which were adding about 8%, kind of at an annual rate to home prices. That plus undersupplied markets plus pretty strong economy meant we were seeing prices rising in double digits. Then through that 2005 to just pre-financial crisis period, a lot of that was about a really undersupplied market. If you go back and look at housing starts and completions during that time, I think they were near kind of a decade low. And then the 2015 to 2016 period and 2020, which we will isolate here. So I think this past 5 years has probably garnered more attention for the housing market, especially in Vancouver, than any other period in quite some time. That 2015 to 2016 period really gets a lot of attention. That's when we were seeing record levels of home sales and kind of record prices in Vancouver. That's right before the foreign buyers tax came in, and a lot of real interest in foreign investment, and this foreign investment driving the entire market. So this is where these decompositions are really interesting, because we look at that period 2015 to 2016 when prices were really accelerating, and there was a lot going on. There was almost sort of a perfect storm for prices, where we had very low supply, we had a really strong economy, employment had grown about 10% from 2015 to 2017. Interest rates, so the 5-year fixed mortgage rate hit a then record low of about 2.4% in 2016, and rates had generally been falling since 2013. So interest rates were putting a lot of upward pressure on prices. A strong economy was putting a lot of pressure on prices, and then we had sort of strong price expectations, which were kind of adding even more to those shocks. So I think that foreign investment piece is probably built into price expectations, though local investors and local buyers are just as capable of having runaway price expectations as their foreign counterparts. So you can't kind of just apportion blame all to external forces. You can see what happened after the foreign buyers tax. And then there was a stress test for insured mortgages in 2017, 2016 as well. There was a recovery after the foreign buyers tax, which really kind of here shows up as a real swing in price expectations and a hit to demand, causes a little bit of excess supply in the market. Rates were still really low though until about mid 2017, so they were still propping up prices a bit. Then we had the B20 mortgage stress test. That applied to about 60%, or maybe close to 2/3 of new mortgages had to now qualify at their contract rate plus 200 basis points. So 60% of the market all of a sudden having about 25% of their purchasing power erased overnight had a huge impact on the market. That was somewhat compounded by the speculation tax. We've done work on the speculation tax as well. and it was certainly a factor in that downturn from 2018 to 2019, but not the driving force that a lot of the media makes it out to be. We had rising rates, slowing employment growth over that period as well, which shows up here. And then, of course, we had the pandemic, which shows up in the model as a big demand shock and shock to price expectations. And most importantly, as a pretty large supply shock. So this is fascinating because normally in a recession, if we had double-digit unemployment, normally what you see is a real pileup of listings. So people lose their jobs and are forced to unfortunately sell their homes. It's what we saw in the financial crisis. We were expecting to see it again here. Instead, we got listings actually falling, I think largely because of social distancing. People certainly just didn't want strangers coming into their homes and touching all of their things. For a while, the real estate market was more or less shut down. So we saw listings actually start to fall at the start of the pandemic. They're kind of normalized now, but we're still at levels of inventory that are extremely low. So interestingly, a lot of the upward pressure on prices for the post-pandemic period shows up almost entirely as a supply shock. I thought there'd be much more of a role for mortgage rates, but it's kind of within the way the model works. It would forecast that due to a large demand shock, interest rates should fall, and as they have. So it's not interpreted as a true sort of shock within the model, although you can see towards the last couple of months of 2020, there is some upward pressure for mortgage rates as well. All right, so the big kind of question, one of the things we're trying to answer is, what does this mean for government policy? And if we look back at drivers of home prices, it's demand from strong employment growth, it's low mortgage rates, it's price expectations. A lot of those things are out of the control of provincial governments. The one thing they can really control, have some influence over, is supply. And supply right now is very, very low. And it's been low for a while. If we think about it in terms of the housing stock and how much of the BC housing stock is sort of turning over on an annual basis, we've had this pretty long decline for about the last 15 years, where listings as a share of the housing stock just keep falling to the point now, I think, updated for 2020, I think we're at about 6%, or about a 30-year low in terms of how much of the housing stock is turning over. A lot of that is demographic. We have a lot of baby boomers who are retiring or sort of located in the houses they're going to be in for a while, are not looking to move. So we're just not having the same amount of churn in the market as we need. The other reason why supply is so low is we're really good at starting to build things and really bad at completing. And we need to have higher completions in order to increase the overall housing stock and increase listings, just get more choice in the market. And so we need to get better at building things faster, and we're getting worse at building things faster. If you look at the time to complete, for most of the housing stock, a lot of what we build, especially in Metro Vancouver now, is apartments, because we just don't have, because of zoning and other issues, we can only really build apartments in order to meet sort of density requirements and meet population growth. And apartments take about 2 years to build, and that's after a very lengthy permit process that can add another 2 or 3 years to this process. So demand, which can change very rapidly, as we've seen this year, in 2020, we saw demand fall very fast, and then, or sales rather, fall very quickly and rebound very quickly. But supply takes a really long time, especially new supply takes a really long time to get to the market. To build a new apartment, we could be talking about 5 years, which is essentially like a whole housing cycle in itself. So one of the ways that we can really help on the affordability side and help with sort of the volatility in home prices is making sure we can build things faster and match supply and demand a lot quicker than we are now. We won't get those sorts of unsustainable accelerations in prices that we're currently seeing. So to summarize, growth in home prices is a function of many factors, kind of all the time. but it's not always impacting home prices in the same measure. So sometimes supply is really important. Sometimes mortgage rates are really important. Sometimes, like in 2016, everything is important all at once and are driving home prices higher. So you can't just sort of scapegoat or single out one specific factor when we're talking about the housing market. Shocks to housing demand and interest rate have been the largest contributor to fluctuations in home prices. But government can't control those things. Or in the case of strong demand from a rising economic growth, that's not something you want to limit. That's something you want to encourage with policy. So what we recommend is policies to increase the overall housing stock so we can grow the supply of listings and really sort of temper the volatility in home prices.